In this lecture, we're looking at the second part of IAS 21, particularly a foreign operation. And here we're looking at a foreign subsidiary, how to translate that back into euros and then consolidate it in a euro set of group accounts. So in the previous part 1, we would have looked at individual company transactions. So how do you deal with a foreign sale, foreign purchase, or maybe a foreign loan or foreign deposit? And we looked at the concept of monetary items, non-monetary items, how to initially record it and how to subsequently record it when you have a foreign exchange gain or loss on retranslation or a gain or loss on settlement. So you can have that at any question because it doesn't relate to consolidation. The focus of part 2 today is when we have an interest in a foreign subsidiary. So when you have a foreign subsidiary whose functional currency is going to be dollars or sterling or Aussie dollars or Japanese yen, we need to be able to translate a whole set of financial statements, not just an individual transaction, into the presentation currency of the group, which is going to be euro. So that's what a foreign operation is. We just look at foreign subsidiaries. We don't worry about the rest of them, but where the presentation currency differs from the functional currency, that's the method we're looking at. So what you'll be given on the day of the exam, if it comes up, you'll be given a column with a subsidiary, but it's going to be in dollars or it's going to be in sterling. So you can't just add parent plus sub plus adjustments because it's a different currency. And what makes it trickier then is it's not just a straightforward convert everything at the same rate, because IAS 21 has specific rules. And we call those rules the closing rate method, where the presentation currency does not equal the functional currency. So all assets and liabilities, this is only of the subsidiary now, because of course the parent is going to be in euro anyway, are at the closing rate. So the closing rate, if you want to write down there, that's the exchange rate at the reporting year end. So whatever the 31st December, whatever it is, you convert all assets and liabilities at that rate. So your non-current assets, your current assets, your liabilities as well. All income and expenses at the exchange rate at the date of the transaction. So for example, if you acquired a subsidiary this year, all the income and expenses for this year would be at the average rate for the year. So we usually use the average rate as a simplification. So that's important that we're saying there, income and expenses are post-acquisition income and expenses. So post-acquisition profits. All of them, i.e. the P&L, are converted at the average rate for that period. Now that is important because, for example, if you have acquired a sub 2 years ago, you will have 2 periods of post-acquisition profit. The first period of post-acquisition profit will be at the average rate for year 1. The second post-acquisition profit for year 2 will be the average of year 2. So it gets a bit more complicated when you have current year and prior year, as you will see when we go on to the more advanced questions. And lastly, then the equity section, any share capital, or for example share premium, they are converted at the rate of the date of acquisition. So when you acquire the subsidiary, you convert them at the exchange rate at that date and you don't update it. So we call that the historic rate. So whenever the date of transaction was, and any pre-acquisition reserves. So any share or retained earnings that were there at the date of acquisition, they're converted at the historic rate. And then all post-acquisition reserves, that's essentially the same as bullet point 2. Your income and expenses are your post-acquisition reserves. And they are converted on the date at which the reserves were earned. What they mean by that is, if you have year 1 post-acquisition profits, you use a year 1 average when they were earned. If you have a year 2 post-acquisition profits, you use a year 2 average rate when they were earned. And all those rates will be given to you in the exam. But the key point then is, well, where do the FX differences go? So we'll focus on how to calculate them, but then you have to focus on, well, where do they go? Everything goes through the OCI. So unlike part 1, where all foreign exchange gains or losses go to the P&L directly, these all go to OCI. So that will mean, like revaluation reserve, you will have a separate line item in the equity section. It'll be called Group FX Reserve. So that's an important one when it goes through the OCI. Right? So essentially, where do the foreign exchange differences come from? And there are essentially 4 differences. Now I've called them 1, 2, 3A and 3B, but you can call them 1, 2, 3, 4 as well. 2 of them you will always have. And this is from the translation of the subs financial statements. So nothing to do with Goodwill, nothing to do with consolidation. But when you translate opening net assets which would be at the historic rate when you acquire the subsidiary, and then you're translating the closing net assets at a different rate, i.e. the rate at the year end, you're going to have an exchange difference. There's going to be a plug figure there. So we call that FX difference 1. So bear with me as I explain through it. When we go through the questions then, you'll start to see how it slots in. You'll also have a difference because you're translating the income and expenses at an average rate, but then the assets and liabilities at a closing rate. So by definition, the statement of financial position is not going to balance if you're converting things at different rates. So the plug figure is going to be your FX difference, which we can prove and calculate. So those FX difference 1 and 2 will be one of the first workings you do in every IAS 21 question for a foreign sub. Because when you translate a set of financial statements, it won't balance unless you calculate the foreign exchange differences. It will balance in the foreign currency, but because we're dividing by different rates, depending on which item it is, based on the rules, it won't balance in euro without these. So put a note there, FX difference 1 and 2. FX difference then, 3A, is to do with goodwill, and 3B is to do with fair value adjustment. These are separate and they're to do with the consolidation adjustments. You will calculate goodwill and acquisition as normal, in euros. But under IAS 21, goodwill must be retranslated at the end of every period. So you must retranslate goodwill at the closing rate and recognise an FX gain or loss depending on where the exchange rate goes. And the same for any fair value adjustment if it's in the question. Whatever that fair value adjustment was at the historic date of acquisition, that will go into goodwill. But every period since then, you will have to update it or decrease it or increase it depending on where the exchange rate goes. And we will look at them in question 7 and onwards in your question pack. Question 6 just looks at the basic FX difference 1 and 2. Question 7 brings in a small bit of goodwill, how to deal with that. And then question 8 onwards, you're getting to more exam standard with everything put in. And the other small thing to watch for before we go into a little example is, if it's FX difference 1 and 2, that's in the subsidiary. That means if there's an NCI, you have to split FX difference 1 and 2 between the NCI and the group. If it's for the NCI, it goes to the NCI line item. You don't split it out. The NCI only has a single line item. If it's for the group, it doesn't go to group retained earnings. It goes to a new line like group FX reserve. So it's very similar to how you treat revaluation gains or losses in the OCI. For the goodwill, that's a tricky one you need to watch for. Goodwill FX differences will only go to the NCI if the NCI is measured at fair value. So think about that for a second. We're being consistent. If the NCI is measured using method 2, fair value, that means it has some goodwill attached. So this is similar to how we treated goodwill impairment. So if NCI is method 2, it has goodwill, therefore it should get a share of goodwill impairment, therefore it should get a share of goodwill FX differences. If NCI is method 1, it has no goodwill attached, therefore it should get no share of goodwill impairment, like we've done in the earlier part of semester 2, and it should get no share of goodwill FX differences. So it is important to think through the logic of each of those. Fair value adjustment is making adjustment to the sub, therefore it will always be allocated to the NCI as well. Whatever the difference, the FX gain or loss in fair value adjustment, and you'll see that from question 8 onwards. And what I've given to you on loop, as you'll see it is, there's an FX summary table trying to help you to summarize, because I appreciate this is probably the hardest area in consolidations. I try and give you the key rules across each of the statements. So the P&L translated at the average rate for the period. Statement of financial position, share capital and pre-acquisition reserves at the date of transaction, post-acquisition reserves at the relevant average rate, depending on whether it was this year or the previous year. And all FX differences are shown in the OCI. And then we're showed that there's actually 4 different FX differences you could have. FX difference 1 is because you're translating opening net assets at a different rate than the closing, and it's attributable to the NCI. And I tell you how to calculate it there, but we'll look at that in examples. The post-acquisition profit, because profits are translated at the average rate, but assets and liabilities are translated at the closing rate, and that's attributable to the NCI. And then goodwill FX differences and fair value adjustment FX differences. So I try and give you a kind of a dummy's guide here, or ladybird version of how to go across each one. But remember, that won't make sense until you start doing a couple of questions. And we have plenty of questions to practice here, right the way down. So for now, just be aware that it's there. But I want you to focus on the slides and the little examples that we work on as we go through. So let's look then at a kind of small example we're bringing our way through. So FX differences 1 and 2, guaranteed in every foreign subsidiary question, because you're taking the foreign subsidiary's statement of financial position and translating it. It will balance in the foreign currency because you're given it balanced, but when you're dividing or converting at different rates, of course it's not going to balance in euros without some FX differences being put in to balance it up. So the main reason we have it is closing net assets equals opening net assets and retained profits. And we know that in terms of, remember, your net assets is like your equity. So your closing equity is your opening equity, share capital, retained earnings, etc., plus your profits for the year. So we'll ignore dividends for now. And net assets, we're told closing net assets here, one side of the balance sheet, is translated at the closing rate. So whatever the rate is at the year end. Whereas we know the opening net assets, they are translated at the historic rate. So one side of the statement of financial position is translated at one rate, the other one is translated at the historic rate, and profits for the year we know is translated at the average rate. And there are particular rules around IAS 21. So of course, when we come to translate them into euro, it's not going to balance. And the difference arises because opening net assets, they are at the historic rate, whereas closing net assets are at the closing rate. Retained profits for the year are at the average rate, whereas closing net assets are at the closing rate. So the difference between these two is FX difference 1. The difference between these two is FX difference 2. And that will give you your FX gains or losses. And we'll show you with a simple example first in the next slide, and then we'll move on to question 6, which just puts it on a set of financial statements. So take this small example where you're given a very basic extract from a statement of financial position in dollars. Opening net assets was $200. Retained profit for the year was $100. So that must mean closing net assets is $300. And that's essentially the way a statement of financial position looks, except it's assets and liabilities and equity. But we know there are certain rules in IAS 21 of how you explain each one or translate each one. The opening net assets must be at the historic rate, which you'll be given in the question will say is 5. So that means it's going to be €40 when we translate it to a euro set of financial statements. Retained profit is 100. That has to be converted at the average rate, which is 4.5. That's 22. And then the closing net assets, i.e. assets and liabilities, that must be converted at the closing rate, which happens to be 4. So that means that's going to be 75. So when we come to prepare our euro statement of financial position, it doesn't work. 40 plus 22 does not equal 75. There's a missing 13. Right. It does work in dollars. 200 plus 100 is 300. It would work if we had all the same exchange rate, but we don't because they're all different rates. So we know there's a foreign exchange gain because it's increasing of 13, because 40 plus 22 plus 13 is 75. Now that's only a plug figure. We can prove it, and we can prove it by calculating FX difference 1 and 2. The reason there's a 13 difference is this 200 is converted at 5 instead of being converted at 4. This 100 is converted at 4.5 instead of being converted at 4. And that will make your difference. So that's FX difference 1, the 200 will explain, FX difference 2, the 100. So let's have a look at it then and see. So we're saying FX difference 1, the opening net asset, it was converted at 5, which gives us 40, but the rest of the assets were converted at 4. So if it was converted at 4, it would have been 50. So that means there's an FX gain there from when it was previously converted to what it is now in the statement of financial position through net assets. So that means there's a gain there of 10. And in your retained earnings, it was converted at 4.5. All the rest of it, in terms of statement of financial position, is converted at 4. So that's a gain of 3. And you can see where the 13 comes out of. And that's the approach you're going to be taking in question 6 in a minute, is you're going to be given a statement of financial position in a foreign currency. You're going to try and convert it to euro, but it's not going to work. So we're going to leave a plug figure and then figure out what the exchange gain or loss is. So you're working back to what it is, and then you can prove it in first principles. You will have to do this proof to show that you understand where it comes from. So that's just a simple example to see where the 13 comes. And now you have opening net assets plus profit for the year, and this will be called FX reserve. And it will be a positive FX reserve because you made an FX gain. So just make sure you go back over that and understand why it balances in dollars, but it won't balance in euros, because you have a different set of rules. And what happens then is the plug figure is your FX reserve, your FX gains or losses, which you have to figure out then what they are. So in the first instance, I want you to go back, have a look at question 6. It is available now on Loop, question 6 corn, and work your way through it. All right. So again, I'm assuming now you've looked at question 6, you've worked your way through it. The only other 2 complications you can have now is you will go on then, which you didn't do in question 6, and you'll calculate goodwill. You'll calculate goodwill using the investment figure that's given, and you'll use, importantly, the converted share capital and retained earnings from the subsidiary. Don't use the foreign currency, and watch for that in question 7. Use the euro-based conversion. When you calculate goodwill then, it must be retranslated at the end of each period at the closing rate. And if you had a fair value adjustment, you won't have this in question 7, but you will have it in exam ones, that must be retranslated as well. And I call those exchange difference 3A and 3B. So you'll proceed as normal in calculating goodwill. The only difference is you have to retranslate it at the year end and recognize the gain or loss through the OCI. Right? So remember, you have to then figure out, well, does the goodwill FX difference get attributed to the NCI or not? And that depends how the NCI is measured. If the NCI measured at fair value, it should get some amount of the goodwill FX difference. If the NCI is method 1, then all of the goodwill FX difference goes to the group. So make sure you pause it again now and go back and have a look at question 7. And also, if you can, have a look at question 8. Question 8 is a bit trickier now. Question 6 and 7 only looked at a current year acquisition. So that meant all the FX differences were current year, so they all went through the P&L. What you'll see in question 8 when we get onto it, question 8, which is called Ireland, if we just go down and briefly look. Ireland was acquired on the 1st of August 2011. It's now the 31st July 2013. So this is a post-year or prior year acquisition, which means you have 2 different years. One current year FX differences, one prior year. That's quite a bit more complex. So make sure you understand 6 and 7 before you go on to question 8. Right. So again, the key point there is particularly you'll have FX difference 1 and 2 in every question, and you most likely will have goodwill as well. But sometimes you'll have a fair value adjustment, other times you won't. But the complexity is when you bring in an NCI, how to allocate those FX differences out, and also when you bring in a prior year acquisition. And as you'll see in my summary document, you have 2 prior year acquisitions, question 8 and question 9 to work off. And you have 3 current year ones. That revision question will be released in a week or 2, but you have question 10 and 11, both of which will be screencasts in the coming days. Right, so just important to practice those, the differences. Current year acquisition is a bit more straightforward. You don't need to worry about splitting current year and prior year. Right. So if you want to have an example, then you can have a look at Glanbia in their P&L and their statement of change in equity, and have a look at note 24 in their annual report as well. So if you just have a look here, you can see in the Glanbia annual report, there's your income statement. That's down to profit. In the next page, on page 119, they have other comprehensive income. Don't worry about those 2 headings. We're not too concerned about them. But currency translation differences, see it there, 58.6 million. So it's a separate item, like you have a separate item for gain or loss and revaluation of tangible assets. You'll also have it here, the currency translation differences. And when we come to the statement of changes in equity, you'll note there's a section called Other Reserves. And in there is currency translation differences. See the 58.6 again? And if you go to note 24, it just breaks out what's in that other reserves. All of them are in other reserves. Capital, merger, currency, hedging. We're interested in the currency reserve. There's your current differences to 58.6 again, opening to closing balance. And if we go down to note C, which explains it, it'll tell you the currency reserve reflects the foreign exchange gain or losses arising from the translation of investments in foreign operations, which essentially is what we're covering. Right, so this, they don't say IAS 21, this is IAS 21. There's a lot extra there that we are not concerned about at this level, but the point is it's a separate section, and that's only the group's portion. If they had an NCI, their share of the translation differences would go towards the NCI. So you have to be careful then when you're looking at the group OCI here, and when you're attributing that to the parent and to the NCI will have to get a share of that translation differences. You have to consider what is current year and what portion of that goes to the NCI. And that's covered quite well in question 7, just at a basic level. All right. So I then give you an approach of how you go down through each of those, and make sure to look at this approach when you're going through question 7 and onwards. Right, you get question 7, question 8 gets a lot more difficult, and then 9, 10, and 11 are all past exam level questions. So it does take time, but I said this is the hardest area of the 3 complexities. Disposal of a sub, foreign sub, and the last thing to cover then will be consolidated cash flows as well. So just make sure you use them as you go down along. Right, and you can see it in the model financial statements if you want, but it's probably better to look at the Glambia ones, which is a bit easier to look at because there's numbers involved and it's easy to follow through. So question 8 to 11, there will be screencasts available, a lot of them already, and there'll be more revision quiz 3 will go up, and there'll be a revision pack as well with more FX questions. So you'll have plenty of recordings and online tutorials available. Don't be afraid to ask questions as well, because this is tricky, but a lot of it is about repetition. The more questions you go through, and hopefully what you'll see is you'll have 1 or 2 big workings for FX at the start, and then a lot of it is the same NCI calculations, the same Goodwill calculations with a couple of extra bits. Right, so that's the final piece of IAS 21. There's 2 parts to it. Make sure you can do part 1, the individual transactions, and then worry about the closing rate method, which is translating a foreign subsidiary. Right, there's plenty of questions there, and it's probably the hardest area you'll come across in semester 2. So it is important that you do put a bit of effort in and go through all of those screencasts and questions. So the next thing we'll look at then is consolidated cash flows, which will be a separate recording.